This is Quantitative Lit, Lesson 5-1, the guided notes. So when we talk about savings and investments, these are the things that we look at our savings strategies. Saving is setting aside money from our current income to meet later expenses. People save for all kinds of stuff. We'll talk about that as we go along. And then investing is using money to purchase something that you expect to provide a profit in the future. When we're selecting savings and investment, we have factors that we need to consider. Can we liquefy, or the liquidity of an investment or a savings? That's the speed. And then when we talk about speed, we talk about time. Can I liquefy in a year or in 6 months, or do I have to wait longer? And ease, is it a phone call? Is it pushing a few buttons on the computer? Do I have to go through a huge ordeal? The speed and the ease, which an asset, and that's what these are. When you invest in something or you have money in the bank and savings, those are assets. But the speed and the ease that we can turn that asset into cash is the definition of liquidity. Everything comes with a risk. And so that's the chance that you take that you will actually lose your money. When you're really rich, it's okay to take chances with your money. It's a little harder when you're saving, just in case you have a flat tire or need to go to the doctor and need that money. So our risk tolerance is how that's determined. A person's ability to ride out the ups and downs of the market. Now, the market, if you're saving money, investing, you're going to invest in the market. Maybe through a bank where you don't pick the actual stocks, but there's some kind of stock market investment there when you're investing. Without panicking. That's important. Because one day a stock may be going down and the next day it may double or triple. So when the value of investment goes down, that means that you're able to wait on it to come back up, ride it out. A return is the amount of money that you're going to gain or lose. So when you think about gains and losses, you're thinking about positive amounts of money that you're going to get back, or negative, you're losing money. But those are still returns. You can have a negative return. You can lose $5 on every 100 that you invest pretty easily if your stocks go bad, or you could gain 15 or 20 on every 100. Just depends. That all depends upon this next word, which is diversification. It's the process that we reduce our risk by spreading our money among various types of investments, such as stocks, bonds, etc. Inflation is just the steady rise in the general level of the price of goods and services. We all experienced that. Like 2 years ago, milk was like $1.50 a gallon at Walmart. Now it's $4.50. That's inflation. Due to why? Lots of things have gone up. Goods especially, and services. COVID has hit us and hit us pretty hard in that area. Taxes. When something is taxable, it means you pay yearly taxes on the returns from the investment. So if you have a taxable investment and you made $10, you're going to pay some returns out of that. So you're not going to see that whole $10 because it's taxed just like income. Tax exempt investments are exempt, just like they say, exempt from taxes completely from, federal taxes. You'll probably still have to pay state because they're not going to let you out of that. But from federal taxes, when it says it's tax exempt, that's what it's referring to. Tax deferred investments are those where the taxes are deferred. Let me give you another example for that word. Put off till later. Like you may have some profit now, but you don't have to pay on that profit up front. You can file it later with your income taxes and stuff and tax deferred. Or maybe it's deferred for 10 years because it's a particular kind of investment. When this investment is sold or the earnings are withdrawn, so that's when you're looking for tax deferred stuff. You sell your investment and the deferred tax may give you 5 years. You may have 5 years to pay on that tax. Or when you pull your money out of a certain kind of account, you may have a year to pay on it. These are all stages. All of this talks about stages in the life cycle of an investment. Talk about the time value of money. When we talk about that, we look at factors that affect the future value of money, which includes the amount of money that you invest and the rate of return. That's how much you're going to make. Say it's 1%. Maybe it's 9%. Maybe it's 11%. Maybe it's 3%. That's also called your yield. When you make money, that's your yield. This first lesson in Module 5 is all about vocabulary so that you can understand the entire module. Okay. When we was talking about time value of money, like we're in this section about the time value, what we talk about is the length of time when money is invested. And obviously, you're going to make more money if you leave it in there 5 years than if you leave it in there 1 year. And then the rate of inflation that goes along with that. Let's say that a year ago, let's say before COVID, you had bought money in dairy. And if milk was selling for $1.50 a gallon then, and now it's $4 a gallon, well, that inflation would give you more money because you had held out for this length that your money was invested in dairy products. The increase in an amount of money over time as a result of invested earnings is known as the time value of money. Okay, moving on here to comparing savings and investing options. So when you talk about savings options, you really have two that you can look at in general. There's more, and we'll talk about them in other lessons, but right now we're just going to talk about savings account and interest-bearing checking accounts. So a savings account is the simplest way that you can earn interest on small amounts of money while keeping that money readily available, accessible, however you want to talk about it. You just put your money in a savings account, save for a rainy day. safer if you have car trouble or if you need to take time off work for something and need some income. And then an interest-bearing checking account is a way that interest is paid on your checking account if you keep a minimum balance. Now, if you ever drop below that minimum balance, then you are going to pay probably a fee. Usually this minimum balance, most banks, it's $2,500. Some, it can be as low as $500 to keep a minimum balance in order to earn interest on your money. And you're going to earn on the minimum plus whatever you keep in there, on the regular. If you've got money in there over the minimum for a day, then you'll earn that day's worth of interest. But if you leave money in there for a year over the minimum, then you'll earn a year's worth of interest on that. And then we talk about investment options. We have certificates of deposit, which are purchased for specific amounts of money. Let's say you buy a $1,000 CD. That's called a CD, a certificate of deposit. Say you buy a $1,000 CD at a fixed rate of interest for a specific amount of time. So most CDs are at least a year long. You can get some at 6 months. And they're going to pay a little bit more in interest than a savings account if you leave your money in there for that period of time. And then there's the U.S. savings bond, which is government issued and backed. And government backed, you buy a savings bond for $50 and leave it alone for 20 years. It has a nice return on it for that savings bond. It's way more than you would make in a savings account for that amount of money. And when you talk about U.S. Treasury securities, it's the same thing as a savings bond, but it's directly dealing with U.S. Treasury. And these all have $1,000 minimum. When you talk about them, you can only buy them in $1,000 minimums. And they have a 6 month. That's the shortest term you can have for one. And some of them go as long or have lengths of 2 to 10 years. When you take out life insurance on yourself, it's an insurance with a very low return on savings. That's going to be really determined by your age and your health. The earlier you can take out life insurance, the lower it is, and the less it will cost you in the long run. For stocks, when we talk about stocks, we're owning shares of stocks that makes you part owner of a company. So if you take out Walmart stocks or you take out Amazon stocks that are traded on the stock market, then those shares are like being a piece of the owners of the company. Companies who issue 2 types of stocks usually. We have common stocks, like I talked about, Walmart, Amazon, and preferred stocks, which just depends on the company. I can't think off the top of my head, but you heard of it's usually going to be medical companies, exploratory companies, preferred stocks or other stock market or other investment companies. You just buy stocks in an investment company. Those are preferred stocks. Bonds, when you own a bond, you have actually loaned the government money. And what happens here, well, I'll say the government. It's not just the government, because you can buy U.S. bonds too, but it's a company. If you buy bonds in a company or a government, then you own, it's like having a savings account with them. They're using your money to do things over a period of time with a promise to pay you back with interest. It's like giving them a loan. And that's how a lot of companies and governments operate. Of course, our government operates on bonds also. Mutual funds. When you buy mutual funds, these companies have invested the pooled, that means everybody that invests in them, their money gets thrown together, and the pooled money of their investors in various types of investments. So you take these companies that do mutual funds, they take money from 1,000 people, they throw it all together and they invest it in a stock, and everybody gets a return on that stock. Sometimes the more you buy, the more you make. It just depends on what the stock is. Insured money market accounts are just savings institutions that you put your savings in. And just like a saving account for money, in short-term investments. So, these are risky. You might or might not make any money. Okay? There's a higher risk involved with these. Higher risk is involved with insured money market accounts. When they say insured, they're just guaranteeing that you'll get back what you put in. They're guaranteeing that, but they're not, if they lose money, they're going to take the hit on that. You're not going to lose any money, but you may not make any either. So a money market mutual fund is when your financial institution, invests your money in short-term debt obligations. An insured money market account is going to give you back your investment. A money market mutual fund is where your bank is handing out money to help companies or to help. It's insured, federally insured, just like all of these accounts, except for stocks. Stocks are not federally insured. We'll get into that more when we get to them, but it's another way that you can make some money pretty easily. And then finally, we talk about real estate. And home equity is when you're paying a house payment, not rent. You're buying a house. So every payment you make, part of it goes to what it costs you to build that house. When you get below what it would cost to build it, then you've started building equity in your home. And that's an easy way. That's an E, equity in your home. Rental units in our commercial buildings, owning them can produce income from the rent that you draw off them. Okay, that's the first lesson. There is a Google form in the Google Classroom. Please complete that Google form and you can move on to the next lesson.